Hello guys, in this video I will reveal an effective trading strategy involving the Commodity Channel Index, strategy which I mainly use when I'm trading stocks. The CCI is an oscillator used in technical analysis in order to measure the variation of a stock's price from a statistical mean. High values indicate that prices are unusually high compared to average prices, while low values of the CCI indicate that the prices are unusually low. CCI is one of the most popular indicators, and traders always tweak their settings of this indicator depending on their favorite time frame or trading style. Most of them use the standard settings, CCI set on a 21 period. CCI 14 period or 50 period are also popular among traders. Our CCI trading strategy involves three conditions to be met. Here's the first condition. The CCI must reach overbought or oversold conditions twice. The Commodity Channel Index is used by many people in a wrong way. When the CCI hits or exceeds values of -100 or 100, many traders interpret this as a signal to enter counter-trend positions in response to overbought and oversold conditions on the market. But sometimes the prices can stay a long time in these areas, and during this time they can continue to go higher or lower. That's why we need the CCI to reach overbought or oversold conditions twice. Also, we will use values of 200 and -200 for these levels to eliminate most of the noise. In this NVIDIA chart, observe the CCI reaching oversold conditions twice, respectively the -200 level. Here's the same condition met on an ExxonMobil chart. The CCI reached -200 level once and another time 2 weeks after. Most people would have taken a long signal the first time the CCI reached oversold conditions, but this is a sure way to lose money on the long run. It's better to be conservative and wait for the second move in the oversold territory. But this isn't enough. We need something else to happen on our charts. Here's our second condition. We need a regular divergence between the CCI and the price. A regular divergence is characterized by higher high prices and lower CCI indicator values during an uptrend, and lower low prices plus higher CCI values during a downtrend. Most novice traders search for CCI divergences on the charts and automatically interpret this as a valid signal to enter the market. Just because a CCI divergence appears on a chart, this doesn't mean that you should automatically enter a reverse position. So we need the CCI to reach -200 or 200 level, but it also has to form a divergence. In this Verizon communication chart, we spot a regular divergence on the CCI, but we also take into account the first condition, respectively the indicator must reach the -200 level. Here's the same conditions met on an AT&T chart. The CCI reached the -200 level and formed a regular divergence. By now, I'm sure you noticed that I only showed examples with the CCI in oversold conditions, and none of the examples were on the overbought side. This is because when I'm trading stocks, I'm comfortable to trade only long positions on stocks with good fundamentals, mainly dividend stocks or growth stocks, so I intentionally look only for long signals. To increase your chances when trading this strategy, it's good to have fundamentals on your side. I use a stock screener to keep an eye on the stocks to trade. Stock screeners make a trader's life a lot simpler than the old days. You still have to do your homework, but you can set screens to create your watch list based on your conditions, and it's gonna save you a lot of time, especially if you're monitoring hundreds or thousands of stocks. With a stock screener, you have a big advantage. I've put several stock screeners in this video description if you want both technical and fundamental indicators on your side with this strategy. Take a look at them if you're interested in trading stocks. Like I said before, you could take signals when the CCI reaches overbought conditions, like this one in the Netflix chart. But from my experience, the most profitable trades are buy entries on stocks with good fundamentals. This trade, for example, would have brought some profits eventually, but not without a period of consolidation. So take my advice and look only on the lower side of the CCI and ignore overbought signals. Now for the third condition, we want to see a clear trendline break in order to enter the market. We want to see the CCI reaching -200 level. We want a divergence between the CCI and the price, but we also want a trendline break to confirm the switch in momentum. Let's see all these conditions met on the Netflix stock. First, the CCI reaching oversold condition twice. Then we see the regular divergence. After that, we simply wait for a trendline breakout. After the price consolidated above the trend line, we can safely enter long on the market. The same pattern on Walt Disney stock. The stock price reached oversold levels twice. The CCI indicator formed a divergence, followed by a trend line breakout. As you can see, we did experience some hit because the price consolidated for a while and retested the previous low before it finally took off. So don't expect a sweet ride all the time. We just have to put our stop orders accordingly and follow our initial plan. Here's the IBM stock, and here's the -200 level hit twice, the regular divergence, and the trendline breakout. Don't be afraid to enter the market when you see the CCI reaching overbought conditions, because this is a classic beginner mistake. Another great trade was on the Visa stock. By now I hope you trained your eyes to spot for this CCI pattern. The oversold level hit twice, the regular divergence, and also the trendline break. You might wonder why we have to wait for the breakout to enter the market. In this example, we could have entered way sooner and obtained bigger profits. But you see, this was a fortunate case, because many times the market decides to search for lower lows and go for the third time or the fourth time in oversold area. By waiting for the trendline breakout, we protect our capital and increase our chances for a true momentum shift. Look at this example on the Procter & Gamble stock. Here we have our first two conditions met, but we didn't have the trendline breakout, so this was a no-go trade. But here we have all conditions met, and we have a valid breakout also. But as you can observe on the chart, the market turned against us, and we lost this trade. But even if we lost this trade, this stock still had great potential for a good trade, which came a few weeks later when we saw the oversold level once again, the divergence, and another valid trendline breakout. This time the stock took off and we managed to regain our losses for the previous trade and recorded some extra profits. Like I said before, if you want to trade stocks and increase your chances when you use this strategy, a stock screener is one of the most important tools in your arsenal. It will help you to sort through thousands of stocks to find only those that match specific criteria. This way you get to choose between stocks and trade only the signals that have the greatest potential. This strategy is designed for time frames higher than 4-hour charts and for stock market, but I've also recorded good results on Forex market on lower time frames. If you got any value from this, please consider subscribing to our channel, share and like this video, as it would help us a lot in the future. Until next time.